Is inflation finally tamed? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Steve Miley, co-founder and chief analyst at TradeDay. Hi, Steve. How are you? Great to have you back on.
Yeah, hey Maggie, I'm doing very well. Thank you for having me back on.
So we're a couple minutes late because we've been struggling. We just ask a lot of technology and sometimes it gets pissed off at us, I guess. So poor Steve has been we've been trying to deal with some audio issues. So we realize he's a little low, but hopefully you can understand it. And we felt it was worth moving forward. And it was a lot better than what we were dealing with a moment ago. So thank you for being such a trooper, Steve, and hanging with us. But we need to talk about these markets because there's been a heck of a lot going on. We had another subdued reading on inflation that helped stocks extend Tuesday's monster rally. I mean, extend is being a little generous. It was back and forth all day, but we did see an advance, a nice advance by the Dow. S&P up about a tenth. NASDAQ was the one who just kind of inched over, but the Russell up a quarter. So, still in the green, given that the gains we saw yesterday, which I think is saying something. Treasury yields didn't see the same sort of follow through. We did have the 10-year back up above 4.5%, 4.53%, but that is after a really big move yesterday. So I'm just wondering what you're making of this market action, and the fact that we did see stocks, seem to shake off a little bit of early wobbles and once again stay in the green. What are your thoughts about this market?
Well, let's just address today. I think first of all, we get PPI and retail sales reinforcing the fact that the economy is holding in there, and inflation's pushing down. One thing we didn't add in there was on your recap, and obviously appreciate there's a US focus, is we also had that UK print today on the CPI, the inflation data, which is also moving in the right direction. And the UK, I'm sitting here in the UK, and that UK data has been very slow to move lower. So, I think, the global picture on inflation is looking better. We did get these mammoth moves yesterday in both bonds and in stocks. And then what we've really seen is just a consolidation of that in the last, 24 hours, which is, from a technical analyst, perspective, that's good enough. That's what I want to see. I want to see the market holding on. And I think what's really significant when it comes to the stock indices, there was that resilience. You said we kind of nudged into the green, kind of finished the day kind of flat, which is fine, particularly given that the Treasury yields, backed up to higher yields today, having had their significant plunge lower in yields yesterday. So, and that's been the tail of the tape, actually. There's been this slight dislocation between, I've been talking to our users at TradeDay now for the past 2 months about, and they're most of them are index traders, and I'm saying you have to watch the bonds. The bonds have been the dog. They've been the dog that's wagging the tail of the index markets, and that is, you've been around for a while, Maggie, and that's not usually the case, right? It's usually the other way around, or bonds are insignificant, or they've got less of a correlation. That correlation has been super high, and it's been bonds driving it. That's kind of broken down. Even though the correlation is still very positive, i.e. it's in the same direction, you haven't really seen it correlate as well, particularly when bonds have gone back down to lower prices and higher yields. Equities have kind of marked time and consolidate. And again, I just think that underpins the equity market. It shows that, if we're going to go to lower yields, we'll take that and we'll go higher. That's what stocks are telling me. And then if we don't go to lower yields, then we're kind of a bit okay with that as well. We'll just hold in. We won't do anything.
Yeah, which is really interesting. And I'm so glad you brought that point up about bonds. Absolutely true, especially here in the US. We are very equity focused. But I guess that's the byproduct of having a super low negative interest rate environment for so long. And now you're back to what is, traditionally more of a normal situation where you do have to watch what's happening with interest rates. And you do have to look across assets. We never talk about FX, but that's a big deal too. So we certainly try to do that. And thank you for bringing up the UK data. Super important to see that happening on a global scale as well, that inflation, that matters a lot. So interesting. A lot of the market watchers yesterday, Tony Greer made a point of this when he was on with us. We're talking about the breadth of the move we've seen this week as being really noticeable, and again, a bullish signal to them. I saw something today, 40 names in the S&P 500 hit 52-week highs, 40 names. Walmart and Microsoft traded back to levels that they haven't seen since they first listed in the 70s and 80s. I mean, that's pretty extraordinary and addresses this issue, which has been a problem for so many people, that it was really limited to the Mag 7, the Magnificent Seven. Does this breadth that we've seen suggest that this rally has staying power?
Yeah, I've been asked the question, is Santa come early this year? We always talk about the Santa rally, it's a bit of a kind of a misnomer, whether it's seasonal or whether it's just something to talk about if the market goes up in December, right? But, has it come early? I think, yes, he has, but I think he's coming again. That's my view. I think we can see this stock index rally run. I think breadth is important. Yes, if you look at momentum indicators, I'm a technical analyst at heart. I can talk macro all day as well. But, if I look at momentum indicators, they are getting a little stretched. They could get a little more stretched before we get into truly overbought conditions. But, those indicators don't take much to kind of, we've got a long way to the end of the year yet. We're not at Thanksgiving yet. So, we've got plenty of time for us to make not only back to the highs on the S&P or the Nasdaq's nearly there already to the highs of the year. But I mean, the S&P, could easily be hitting those highs from earlier on in the summer. And then, I think there's even potential, maybe not for Christmas, but certainly going into January, for us to be hitting the all-time highs. We're closer to the recent lows. Sorry, we're closer to the all-time highs than we are to the recent lows that we put in October. So, we've come a long way, but there's potentially less distance to go to those highs. And, there's no reason we can't get there. Considering we're getting a significant shift in CPI, which, then the key question is, does that lead to a shift in the Fed, right?
Yeah, absolutely. Before we get to that question, you sent over, we have a chart of the S&P. So what are you looking at in terms of levels, next levels that are important, that are either going to confirm, that we are in this shorter term bullish trend or give you reason for pause? What are you looking at from a level perspective?
Yeah, we're kind of blitz through pretty much all the retracements from the sell-off that we saw from, late summer, and then the accelerated lower through October, and then it just into November. But, you got some key peaks and retracement levels. 45.66 is there on the chart, and then we've got 45.97.5 above there. That's going to be critical from September, and then ultimately above there, like we're focusing in on that high. This is on the futures market, but it's up at 46.85. So I think all of those are easily attainable potentially in November, early December. The question mark then is, does the market have the legs to go on and hit the all-time high, which is up closer to 4,800? That's going to be a big ask, I think, this year. But as I say, if you have any kind of dovish view on the Fed, we could easily be hitting those kind of levels.
Yeah, well, which is why the Fed is going to be super important, right? And there is some concern that the speed of this rally, right? We've seen this big move in stocks, we've seen this big drop in yields, is kind of going to undo the work of the Fed. Will the Fed be comfortable with this rally, and does that sort of, release of animal spirits kind of counter that restrictive policy that they've been trying to pursue? Or what do you make of that? Or is that something that you're concerned about?
The short answer is no. I mean, I think, yes, the Fed do keep an eye on the frothiness of the market, but, we're not at all-time highs. We're not making new all-time highs. We're far from that. You can hardly say it's been a stellar year. You could, depending when you got in, you could be either offside or onside, in this year so far, right? It's hardly been a right home about kind of year for stocks, kind of stuff. It's been very choppy. You'd say more sideways than anything else, in a broader range. So, I don't think they're particularly worried about that. And then, what's going to be more on their focus is going to be the potential for us to tip into recession, right? That's their remit. Okay, we know they keep an eye on the stock market, right? But equally, unless it's getting to some kind of irrational exuberance, to coin Greenspan's phrase, so we're a long way from that, right? Then I think there's potential, there's further upside. And I think you make a really good point on the breadth. If it was just running away with itself and wasn't any kind of solidity to it and breadth to this rally, then maybe that kind of tweaks a little bit more of concern in that if it's all in those magnificent seven. But we haven't seen that this time. So if the broader market is rallying, if the broader market is up, if the stocks across the board, you spoke about Walmart, we had those target numbers today, which were great, right? So, all of that points to me that we can go higher without it being a major concern to the Fed, and I think it's going to be really interesting, super interesting to see the pivots from. It's going to be watching the hawks, how those hawks pivot really, because the likes of Kashkari has been out there on the wires just saying it's too soon, it's not dead yet, right? What's it going to take for someone like Kashkari to kind of to have a shift? And there's any kind of hint that someone like him has kind of steps. It only needs to be a moderate step. He's not going to give up his hawkish view, but a moderate step away from that view, then, you could just see a very quick move from the markets and from the Fed to rate cuts coming even earlier than what we're pricing in right now, I think.
Yeah, it's so interesting because that interplay between the recession and do we get a pivot to cuts is something that Steve McGlurk of Valkyrie was talking about. He and Ash had the opportunity to sit down and talk on the platform a little earlier this week, and he definitely had some sort of concerns about how that interplay was going to work. Let's have a listen and we'll talk on the other side.
Yeah, sure.
We're entering into a new election cycle, and even though the Fed isn't supposed to be political, it has become political over the last 6 to 8 years. And when we have an economy where inflation is still pretty high on the things that matter, inflation is lower on things that don't matter, and at the same time, you're starting to see job losses and lack of job growth and general signs of a recession, including an inverse curve. So all of those factors are going to force the Fed into begin to think about lowering rates again. It probably won't happen until May or June of this coming year. But I do expect to see the Fed begin to lower rates at about a 25 basis point clip all the way into the election cycle, which really will be in October.
That full discussion, you can see there's a whole panel there, is available on our platform. It wasn't just on macro, it also crossed over and included a conversation about crypto, digital space, whether or not we're going to see that Bitcoin spot ETF. Really interesting conversation. If you're watching on YouTube and you are not a full member, jump on a trial and head over to app.realvision.com so you can get access to all of that. Worth asking perhaps here, Steve, before we continue, I want to talk about treasuries, but are you trading in or watching Bitcoin, ETH, or Solana right now? They've been on fire.
It's not something that I have a real focus on, no. But I mean, I have been, watching the fact that we're seeing some significant moves in those, and I think it kind of sits with that risk-on move, right? And given that you got that correlation going there, I was looking at the correlation last week, and given that you got that positive correlation going on, with my view here on stock, I couldn't be anything but bullish and continue to be, bullish on the kind of breakouts you're seeing in the whole crypto space, and particularly those.
Yeah, it's piqued a lot of people's attention. We're going to talk a little bit. The Crypto Academy dropped today, folks. We'll talk a little bit more about it at the end, but Artur is in the chat on the platform. If you have any questions, you can hit him up there. Really important time to sort of plug in and pay attention. If you went through the last cycle, a lot of lessons to be learned and maybe corrected on this one. And if you're new to the space, sat it out last time, but want to get involved and know more, now's the time. I'll tell you how you can get to that Crypto Academy in just a little bit. So, Steve, treasuries, you mentioned before, they have been key. We have the sense here they're going to continue to be. Where do you see treasury yields moving from here?
Yeah, well, obviously we had that big rejection up at 5% on the 10-year, right? And then we went into a consolidation phase up until about a week or so ago. But then we broke down through some really significant levels. From yield terms, we put in a topping pattern went in from a technical analysis perspective, and you look on the bond on the prices, it's almost like it's almost like an inverse head and shoulders you got down on the US 10-year on the futures. So it's interesting that bottoming pattern in price and topping pattern on yield is very much in place. And as you said earlier, we're sitting around the 4.5% level. We're kind of just backed up above there.
Right. We're talking about the 10-year here, correct?
10-year, yeah.
Yeah, I think we might have a chart. I don't know if they can pull it up. I don't know if it'll mess with our signal, but so where do you see? So right, we had that big rejection. The pattern's shaping up. What do you see happening from here?
Yeah, so then all the risk is then on the 10-year is like for an acceleration still lower. We've kind of had the consolidation phase. We signaled that higher yield top, and then for me that is pointing. If we're sitting at 4.5 and you've got the 5% peak, and where are the risks? The risk is closer for me to 4%. I'm like 65%, 35%. You'll see 4% before 5%.
Wow. What part of the curve? I know you look across the curve. What part of the curve do you think offers the most opportunity?
From a technical perspective, from here, you'd have to say really the twos to play catch up, and that sits with the kind of view of, they've all got basing patterns on price or topping patterns on yield, across 2s, 5s, 10s, 30s, wherever you look, right? But we've had the bigger moves, arguably been in 30s and 10s, and it's maybe the time for the short end to play catch up, and that's going to need a hint, right? It's going to need a hint, and it sits well with, from the technical sitting with my macro view that the Fed take this kind of dovish shift, and I'm not talking about a dovish shift. I know we watched the soundbite there talking about rate cuts coming in May, but that's pretty much what the curve's pricing in. You look at Fed funds and on the futures market, that's where it's pricing in that it's May, June. That's when the cut's coming. I think there's risk that the yield curve, the interest rate, the short-term interest rate curve, and then in turn the stock indices get ahead of themselves. The market's always further than they should, right? And there's a good chance 10 years are down at 4%. We get some kind of explosion up in price on 2 years. They play catch up, and I think that's triggered by any kind of signal that the Fed is stepping away from hawkishness to dovishness. I think you could see a real explosion, particularly in the short end, where we had a lot of big players in the last 2-3 months who have advocated, aggressive short positioning. I think the last time we were on, that was just starting. Last time I was on, that was just starting. And I think Raul was saying, we need to back away from our long bond view for now, right? Well, I think, what we're seeing now is that there's a real risk that we could get that long bond view, for me, is about to come into fruition. Mm-hmm. And some of those have been in for the last 3 or 4 months. Most of them a lot of them have probably been squeezed out of the longer end, but I don't think they're out on the short end, and that's where the potential tension point is. And that short end is obviously driven, again, I'm back to the Fed, right?
Yeah, great point that maybe they're not out of the short end. Everybody who's going to roll up, Raul's going to be doing an AMA. It would be worth asking him about that, because he's been bullish bonds, but he was frustrated by the timing. So be interested to see on the short end, because we did have that divergence. We still have people, by the way, who believe that inflation is going to be sticky, that the market is overshooting and is got the macro theme wrong. So it's going to be really interesting to see how this plays out. When you're talking about overshooting, they're talking about from a fundamental. They just think that this is sort of probably a bear trap. But when you're looking at this, Steve, do you think that in the short term, it sounds like you're very bullish and there's a lot of momentum, but in the more intermediate term, do you feel like there might be a correction coming because this is happening so fast that they're going to have to sort of have a consolidation phase, stocks and possibly bonds?
I think what I'd have to come back is what I always used to do, and I'm an analyst at heart, is I have to sort of just ask a question on that one, is where's your intermediate term? I mean, for me, as I've said there, from now through to December, for me, it's bond prices up, stock prices up, lower yields. That's where we're going. And incidentally, we haven't even spoken about the dollar, but I think the dollars are going to end up getting crushed. But then equally, I think there is a gut check on all of this. The gut check for me doesn't come from until the early part of next year. And I think that'll be then, I think we could easily see, some recessionary pressures coming through. That's more my view, rather than the stickiness of inflation and then the potential for the Fed to go more hawkish. It's like, well, actually, have we done too much damage? Not just global central banks, put the brakes on too hard, and we are going to, head into recession. Because you have to remember, like, if you look in Europe, we've been teetering on the edge. The US is some ways away, but in Europe, UK, Germany, we've been teetering on the edge of recession, on and off in here for the last 9-12 months. We've had flat quarters of growth, slightly negative, and then maybe had a slightly positive quarter of growth. So we're in sort of de facto, like a hard soft landing at the moment in Europe. But it's whether the US can get through that, and I think we will have a wobble, we will have a gut check, we will have a consolidation phase, maybe the beginning of next year. But then we could easily see, the Fed's got a lot of bullets in the gun, and that's where then we could even see a signal that they're going to be an even more rapid shift, and that's why I think we could see the first rate cut as early as March.
It's interesting. I'm glad you brought that up because, this pivot and the very bullish reaction from stocks is great, except that if it's happening and there's a recession, then everything depends on how steep that recession is. I mean, it's like, that weakness is good news until it's really bad news, because then we're seeing that lag effect happen. And what does that mean for the economy and earnings? That part of it is sort of, not in the discussion at the moment because we're at this transition period. Want to get your thoughts on oil. I know you're looking at that too. The pullback in oil is part of what's been helping presumably take some of the pressure off the inflation story.
Yeah, and that, again, if I look at the technicals, first of all, we broke a key trend line that goes all the way back to May. On the oil chart, also a topping pattern went in there, so yeah, there you see it. You got the trend line. We went and held kind of at the kind of final retracement, an important final retracement level. That retracement level, just looking at my charts here, comes in around where are we, $73, and we bounced off of pretty much around 75. But if you look at the chart, it doesn't take a great technical analyst to be able to see we're in a succession of lower lows and lower highs. We've just had a rebound. I think the most interesting thing for me here, and as sad and as awful as everything that's going on in the Middle East is, when we got that breakout in the tensions of the war broke out effectively, the October rally failed way below where we'd already been in September. That September high, and then we only rallied to 89.85, and that tells me that on one of the kind of worst fundamental events that should have seen oil flying higher, the market had no appetite to be up there, pushing it back above 90, and we fell back miserably down from there. Given we don't get anything escalating within the broader region, my view, if I just look at the technical chart, we're in a downtrend now. All the risk is break through 75, and we're closer to 70. And as you point out there, right, sometimes oil is seen as goes with risk on, risk off. But at the moment, in an inflationary phase, we want oil lower. And I might point out as well, I cover the natural gas charts for some clients here in Europe and in the UK. And those charts are still very much in a downtrend. So that's going to, help that whole inflationary picture. And particularly in Europe, where the natural gas problem is, far more acute than it is in the US.
So great question here from Boris. I want to make sure we get to a couple of them. Hi, Steve. Do you think it might be a good time to add some small and mid cap exposure, or do you expect the mega cap outperformance to also characterize 2024? Great question, Boris.
Yeah, it's a good question. He's caught me a bit as well.
It's also, we could say, the $1 million question, because it's kind of what everybody's been angst about, because they sort of hate that outperformance and leadership. They'd like to see it broaden out, but it's been hard to bet against those names.
I mean, I think the dominance will be less, but I still think they'll be dominant. That will be my view. I look at my own portfolio. What do I own? That's what I own, right? Kind of stuff. So I own those mega caps. I mean, I think, yes, probably in the short term, given the breadth we're seeing, you could possibly see some outperformance. But then equally, growth stocks, big tech, are more sensitive to interest rates. So, if my view is, which it is, that, potentially Fed are going to shift to more dovish if we get an earlier rate cut than the market is pricing in, then, that just says that big tech, keeps its leadership very much intact. I think the leadership's less, but I think that leadership stays intact. It would certainly make up a lion's share, and does make up a lion's share of my portfolio.
Yeah, absolutely. Boris, is one of the reasons we stay on the AI issue is because a lot of people are trying to look at that trend and figure out how far does it move down the food chain? Can smaller companies use that to help their earnings as a tool, as a productivity tool, or is the capex spend on that, a wash? And does that have an impact? David has just David Matten and Ralph just put out the exponential list. These are kind of questions they're looking at when they're trying to figure out how does this feed down to the bottom line and what does it mean for that kind of question, that sort of huge exponential tech issue. Can it be democratized down through the food chain to these smaller mid cap companies? I think that's going to be really important to look at as we turn the corner in these next 2 years. And something will stay on at Real Vision as well. Ralph asking, what is your view? You mentioned Europe before. What's your view of the DAX, CAC, FTSE, et cetera?
Yeah, I mean, I think, we've seen slight underperformance compared to the US, and probably look for that to continue. But, following higher. The one thing you'll have to say is, the ECB, are eternal doves. They were late to the party, in hiking. But I think they'll probably be late to the party in the cuts as well. So that would be the thing that I'd be more concerned about. That you'll keep leadership in the US because the Fed are going to be the central bank they're almost certainly going to be the first to cut, right? There's a really good chance that you might see it elsewhere. You could see somewhere like Australia cut, or New Zealand maybe, but you're not going to get it from the UK in my view, first. And I think the ECB super conservative, right, and more likely to be as slow to cut as they were to hike. So and that probably means that European stock indices continue with some underperformance.
Interesting. We have a couple questions about gold. I know you're looking at that as well. What do you see happening in gold?
Yeah, well, we have had a dip back lower more recently, but then, in the last week or so, getting that rebound, having had that strong rally up from, just double checking the charts here, from October. So, you got that October spurt higher. You've had some now dislocation because it was trading very much in line with stock indices, which is not the norm. That's not the long run correlation, but it's almost trading with risk on. And we're starting to see that again a little bit. And as I hinted at earlier on, and I haven't got a chart on it for you guys, but I am really bearish the dollar. I'm super bearish the dollar. And the correlation that has worked really is that the inverse correlation between gold and the dollar. So if you think the dollar's going down, and with my view on the Fed, with my view on US interest rates, there's a real potential. That's become a super. When we talked about the bond trade, the long dollar trade is super crowded. So you've had some unwind of that, but I think there's a lot more of that to happen. And if we see that start to accelerate, you could easily see gold not only back up to the highs that we saw more recently around 2020, 2030 kind of area, but back up to the all-time highs. And again, not a Christmas kind of present there, I don't think, but probably a Q1 event, maybe up to the all-time highs.
Fantastic stuff, Steve. Great stuff. We managed to sort of make it all the way around. I'll just leave you with a final question, and we've got a lot of the family, the RV family in the chat as well. But Ben asking, could the speed and size of the rallies since November be related to shorts dropping out? I think we see that shorts are getting squeezed, but let me phrase that another way, which is what happens moving forward. Do we see people chasing performance? How much of that will be a factor, that those people who are locked in those shorts? You just mentioned people, the long dollar trade is crowded. We still have people potentially in the short bond trade. We know people sat out the tech rally, just sort of hating the Magnificent Seven, and really sort of staying committed to that. What happens now that we've seen these markets kind of break out? Do we see people have to readjust and chase them higher through the year end?
I mean, again, short answer to that is, I think yes. I don't think there's been a massive short trade like we've had, like the short trade in bonds and the long trade in the dollar. I don't think it's crowded in a short, but I think more underweight, which is what's saying to me, this is not any fast money shorts in stocks are almost certainly out, right? We're back to the highs on Nasdaq, right? And they're not holding on to those. So, from the fast money side, hedge funds are way out. They're probably flipped and long now, in my opinion. But then what I think we're seeing is the real money. The long-term, long-only money is underinvested. I caught the. Oh God, I'm going back some time. I was at Merrill Lynch back in the day, but it used to be the Merrill Lynch Investor Survey based out of the Bank of America that is now run by Michael Hartnett. And I called that, and there's still huge positioning in cash. There's still huge positioning from the long only, the real money accounts, and I think that has potentially all got to be put to work. Maybe that helps with the whole seasonality of year end. Maybe it's like we have to be in at the beginning of the year, and it all plays back into the picture I'm kind of trying to paint, that this. I think there's a real feeling of we've come a long way really quick, right? We grabbed the headlines last Thursday because we just missed out on that 9-day rally on the S&P, right, which would have been a 20-decade record or whatever it was. But I mean, I think and that feels like, oh, this is frothy, right? It's over. It's going on, but I think there's still a lot more of that to potentially come, and it's almost like the stars are a little bit aligning for it to go significantly higher in the short to intermediate term. There will be a correction and a consolidation, but for me, this is not a bear market rally. This is the start of something more significant to the upside.
All right. Fasten your seatbelts. Great point about all that money in cash. We're going to have to watch that. Steve, always great to catch up with you. Thank you so much for being with us.
Yeah, no problem at all, Maggie. I'm glad we got through. The sound held out. So
it certainly did. If there's a will, there's a way. And Nick and Brian are the best, so they're always going to figure out something. We mentioned that piece from Ash in the crypto conversation. I mean, they're some of the best performing assets this year. Talk about no one expecting that except maybe Raul. So just a programming note to everyone. It is officially the first day of the Crypto Academy. Students now have, and those who have signed up have access to the first 2 episodes of the OSF and Mando series on crypto investing. Also a curated selection of episodes designed to help you in the game of investing. Everything that's available in the Crypto Academy can be found by searching for Crypto Academy on the Real Vision platform. Don't forget, people are minting their soul-bound NFTs too. So if you haven't enrolled yet, we still have some lifetime access passes available. Go to realvision.com/Crypto Academy. And as I mentioned before, Raul's going to be here for an AMA on Friday. He's on his own, unhinged, unconventional, let loose with drinks. Watch out, everybody. It should be a lot of fun. So make sure you mark your calendars for that as well. Thanks, everybody. Appreciate the great questions. We'll see you the same time tomorrow. In the meantime, take care and good luck out there.
People are going to lose their minds. This is a moment in history unlike anything humanity's gone through. It's a very different world for humans to come.
Take a step back and see the broad picture, which is the way all these technologies are interlinked.
Because this is all about exponentiality, and humans can't think in exponential terms.
How consequential do you want to say machine intelligence is? It's almost certainly as consequential as writing. How long did writing take to disseminate through the human population? Hundreds, thousands of years. And we're dealing with it now on a scale of months.
But in this kind of world, you're compounding 100% growth every year, and the numbers become astronomical.
AI is going to spot patterns in the world that were just completely invisible to us.
Even if you think that the AI and the robots are your demise, you might as well bloody invest in them and make some money out of it. If not, you're just going to be angry man shaking your fist at the clouds.